Good morning. This is Horizon's Middle East and Africa, our top stories this morning. President Trump says Indonesia will buy 50 Boeing jets and more than $19 billion of American products as they reach a 19% tariff deal. Trump also warning pharma tariffs could hit by next month. U.S. 30-year yields top 5% as traders pare back bets on Fed rate cuts, focusing on the potential for higher tariff-driven inflation over the coming months despite softer core CPI. The world's most powerful finance ministers and central bankers gather in South Africa for a G20 meeting, overshadowed by uncertainty over Trump's trade salvos. It has just gone 8 a.m. across the Emirates. I'm Joanna Bersachi in Dubai. Lots of market action yesterday. CPI, obviously a focus for investors, and the fact that that core number came slightly weaker versus expectations, though beneath the surface, some signs that tariff-related costs have started to hit consumer goods. So that has been one catalyst for markets. We also had the beginning of the U.S. banks' earnings season. Mixed results. Wells Fargo disappointing to the downside. JP Morgan somewhere in the middle, and then Citi very strong results. So net, what you ended up with was a pullback for Wall Street. S&P futures this morning also pulling back about 0.2%, though tech continues to be a bright spot. As we spoke about yesterday, the big story of the day in tech space was the fact that Nvidia once again had received the permission to sell some of their AI accelerator chips back into China. So that was a big catalyst for Nvidia and the tech sector as a whole yesterday. European futures down about 15 basis points as we continue to think about tariffs, counter-tariffs. Also, France unveiling a budget proposal yesterday as well, so keep an eye out on the fiscal developments in Europe. USD trading sideways, though yesterday in an interview with Bloomberg Television, the Treasury Secretary Scott Bessent suggested that the process by which they are looking to replace the Fed Chair Powell after his term ends in May 2026 has already begun. So lots of questions about who his likely successor could be. And then finally, keep an eye on yields. We've been talking about this. 30-year yields now through 5%. These are the highest levels the 30-year yields have seen since June. But of course, this isn't just a unique phenomenon to the U.S. It is happening all over across many markets, JGB markets in Japan, German markets, UK. So fiscal premium, bond premium, term premium, whatever you want to call it, long-end bond yields continue trending higher. As for our terminal chart today, I just want to draw your attention to the fact that on this positivity around tech, around semiconductors, chips, Nvidia, what you are seeing is that the semiconductor index has now hit its highest level in a year. We've fully recovered the ground that was lost into and around that Liberation Day back in April. So back to levels not seen in over a year, and really speaks to the strength of the tech sector in the U.S. Now, President Trump says he's reached a deal with Indonesia that will impose a 19% tariff on its exports to the U.S. He says Indonesia has agreed to erase all duties on U.S. imports and buy more than $19 billion of American products, including Boeing jets.
Indonesia is very strong on copper, but we have full access to everything. We will pay no tariffs. So they are giving us access into Indonesia, which we never had. That's probably the biggest part of the deal. And the other part is they are going to pay 19%, and we are going to pay nothing.
For more, let's bring in senior editor Bill Ferries. Bill, so we have a deal, a trade deal with Indonesia. What do we know about the terms of the deal?
Well, we're still waiting some details, but this 19% that the president is talking about is down from, I think, the original 32% that Indonesia was hit with on Liberation Day back in April. So in that sense, it's positive news for Indonesia. That said, 19% is still much higher than the tariffs Indonesia faced for U.S. market access prior to the Trump presidency. So it is still a big increase from what they've had to deal with historically, and will probably have an impact. There are some aspects of the deal we're still trying to get a little more information on. The president talked about up to 50 Boeing jets being bought. Indonesia has a long-standing uncompleted order for about 50 jets from Boeing, 737 MAXs. So it's not clear if this is kind of an updated version of that, if Indonesia's recommitting to an old agreement or really going out for something new. So there's still some details. I think it is a little bit lower than the 20% tariff that Vietnam was apparently handed just a couple weeks ago. So it's interesting to see that the tariffs so far are settling a bit at the higher range that people expected, 15 to 20% range, rather than down at 10%.
Yeah, that is a very, very fair observation to make. The other possibility that Trump raised yesterday as well is one of introducing tariffs on pharmaceutical products, but also semiconductors, too. I was just talking about the strong performance in the semiconductor space over the last couple of months. That could potentially dent some of the performance. So what do we know about these sectoral tariffs, Bill?
So these sectoral tariffs, Donald Trump saying they could come into effect basically on August 1st. He suggested they would come in at a relatively low level. We don't know what that low level is, but that they would rise over time. He did say that with pharmaceuticals, for instance, he'd like to give the companies at least a year and a half to expand their production facilities in the United States. But he talked a few days ago about pharmaceutical tariffs rising to up to 200%. So if that's also the model he's looking at for semiconductors, it would provide some incentive for relocation of facilities, but it would be also very likely to have a significant impact on the local market. You know, when you're basically two key items for the American economy right there in terms of pharmaceuticals, drugs that people need for their health care, and then the semiconductors that go into everything that modern technology really uses. So potentially significant if you ever got to those much higher tariff levels that the president's talking about a year or more from now.
Yeah, and as I was saying at the top of the show, beginning to see some signs that the consumer goods in the U.S. are beginning to be hit by these higher tariff rates. So small signs there. Let's see how this evolves in the coming months. Bill, thank you as ever for your reporting. Senior editor, Bill Ferries. Now, let's turn to the Fed and who will succeed Chair Jerome Powell. President Trump has raised the stakes by routinely blasting Powell for keeping interest rates too high and saying he'll pick a Fed chair who wants to cut them. Bloomberg understands that National Economic Council Director Kevin Hassett is the frontrunner. For more, we're joined by Bloomberg's John Herskovitz in Tokyo. John, maybe just walk us through why Kevin Hassett is in the pole position. Is there anyone else in the running?
Sure. There are a couple other people who have been mentioned. Scott Bessent, the Treasury Secretary, has been mentioned. Kevin Warsh, a former Fed governor, has been mentioned. But with Hassett, he has been in Trump's proximity for a long time. He's echoed Trump's views on taxes, tariffs, trade, and criticism of the Fed. He's seen as the most MAGA aligned economist of all the people who are in contention. And it's quite a change. I mean, Hassett at one time was part of the conservative economist clique, close to people like Mitt Romney, but he has been in Trump's orbit for some time. He's seen as a trusted ally. He's a prominent voice on television, and he sees as someone who Trump can rely on to help with his views when it comes to the Fed.
Yeah, what does this mean for policy? If he is going to be succeeded, or the Fed Chair Jerome Powell is going to be succeeded by someone who is more inclined to cut interest rates, is it fair then to expect a more dovish Fed looking ahead to 2026, 2027 onwards?
I think what we're going to see is that we're going to have more of a political, it could mean more of a political influence in Fed decisions with a push to cut rates. For some investors, they may see this as helping to spur growth and in the short term being quite good, but it just raises a lot of worries about this wall between the political sphere and the independence of the Fed being eroded. I mean, this could undermine investor confidence, especially at a time of Treasury volatility, and raise worries about how well the Fed can manage inflation and steer the economy in an independent way, free from political influence. So there's a lot going on with this, but we see calls from Hassett and from Trump for Fed interest rate cuts. So we may see quite a change if Hassett comes on as the chairman of the Fed.
Yeah, not least to mention the potential political interference as well for an institution that has prided itself on being independent. Bloomberg's John Herskovitz in Tokyo. Thank you very much. Now, Israel has launched several attacks on Syria and Lebanon over the past 24 hours. The army intensified its strikes on military vehicles in Syria on Tuesday after targeting tanks advancing towards the Suwaida province on Monday. Israel says it was acting in defense of the Druze community, a minority group the Jewish state has pledged to protect. Deadly sectarian clashes broke out in Suwaida on Sunday and Monday between Druze and Bedouin groups. Still ahead, traders price a lower chance of more than one Fed rate cut this year after U.S. core CPI rises less than expected. Macrovisor share their outlook next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Joanna Versace in Dubai. Underlying U.S. inflation rose by less than expected for a fifth month in June, even as the details signaled companies are beginning to more meaningfully pass on some tariff-related costs to consumers. Joining us now is Ayesha Tariq, Macrovisor co-founder. Ayesha, really good to have you with us. The thing about these CPI prints is the headline number comes out, and then we spend a bit of time analyzing what's actually going on beneath the surface. And yesterday was a case in point, because even though the core CPI number surprised to the downside, there were strong signals showing that consumer goods have started to feel the effect of tariffs, even though other parts of the basket are pulling down the overall numbers. So how do you read the impact this CPI print is going to have on potential Fed policymaking?
Good morning, Joanna. Thank you for having me back on the show. So you're absolutely right. And I think we saw a little bit of this even last month as well, where the initial reaction was extremely positive. And then after that, when we started looking under the surface, as you rightly pointed out, we see that there are, portions of the CPI numbers that have started to go up. Now, I think a lot of the impact from, the stocking up prior to the tariffs is still feeding through. So we're still seeing some of those lower prices continue. However, our view was that we're going to start to see some spikes in July, which is, the June reading. And perhaps the July reading will give us a little bit more, of a clue as to what's happening. Now, the interesting thing, though, is we saw the huge tariffs, and then, of course, there was a pause. So likely that we won't see as massive of an impact as was first expected, right? So I think the Fed is still waiting to see what happens once tariffs kick in completely.
Yeah. Do you think it's fair to say that the market narrative has shifted towards the Fed being inclined to keep rates on hold so long as the Fed chair is still Jerome Powell? Is that the narrative in the market now because of these potential inflationary signs to come?
So I think the market always needs someone to blame, and right now it seems like Fed Chair Powell is the villain. But if you ask me, he's not really doing the wrong thing, and it's not just his decision, of course, right? We have a committee who makes the decision. And to be fair, they've been on a rate-cutting, path. They've just held back for a while because of all the uncertainty. I don't think that they're doing particularly the wrong thing here, because there's no harm in sort of pushing back a cut for a meeting or two. It's not like they're saying they're never going to cut or this is the terminal rate. It's just that they want to see the effect of what's happening in the economy. And on the flip side, you have a labor market that is cooling, but not cooling drastically. So they do have some breathing space here to make a more informed decision, let's say.
How are you looking, if at all, to play the transition between the two Fed chairs? And now, Scott Bessent has publicly come out on television. He told our colleagues yesterday that the formal process of selecting a new chair has begun. Is there a trade to be done here, or is it already in the price because markets are already anticipating a more dovish successor to Powell?
So, Jumana, I think there's always an element of surprise with any kind of situation. So even though we like to say things are priced in, I always believe nothing is 100% priced in. Now, it depends on who comes. I think what's going to happen from here until when the Fed chair actually leaves, when Chair Powell leaves, is that we're going to see sort of a shadow Fed kind of situation where we're going to hear a lot of talk about, the new Fed chair being very dovish. So there is, I think, a trade to be made here. We like long end rates higher and, shorter end rates lower because that's where the narrative will take us. And so I think accumulating some of those long end bonds may be a good idea here if we're looking for, a return, fixed income return.
Yeah. Ayesha, let me ask you about earnings season. We kicked things off yesterday with some of the bank's earnings. Mixed bag of results. There's more coming later today. But notable in the price action yesterday that it was really only the tech sector that was in the green. Everything else was trading in the red. To what extent do you think it is still going to be the tech sector driving U.S. equity performance in the coming months?
So I think the tech sector is still front and center, and that's sort of what's driven American exceptionalism over the last, 2 years, right? And I think it's a little hard to get away from that. When you look at positioning, you still see that global positioning is still in the American tech sector, whether, it's, semiconductors or software. We actually think software has a lot of catching up to do, and there's potentially some, opportunities there. But from what we've seen, they've not failed us so far, the tech sector, at least the Mag 7, so to speak. And I think people will continue to sort of put their money behind, the tech sector in the U.S.
Yeah. Ayesha Tariq, Macrovisor co-founder. Really good to have you on the show. Thank you so much for joining us. Now, coming up, major Wall Street banks set trading records in the second quarter. More on what's behind the surge next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Johanna Versace in Dubai. U.S. banks have kicked off earnings season with a strong showing. JP Morgan's stock trading desk delivered a record second quarter, while Citi posted its best trading performance for this period in 5 years. Morgan Stanley and Goldman Sachs are set to report later today. Bloomberg Intelligence's Matt Ingram joins us now. So earnings season has begun. Maybe let's just start one by one. JP Morgan seems to have experienced a strong quarter in investment banking, which came as a surprise to many people in the market, in addition to trading. How are peers placed?
Hey, Jemana. Yeah, look, JPM had a decent quarter. I think you mentioned Goldman and Morgan Stanley to come. They've had an extraordinary first half of the year in investment banking. Citi also, who also reported yesterday, had a very strong period in investment banking. So there's definitely more to come. In terms of the volatility we've seen in the market, that's driving this sales and trading revenue. We've had the whipsaw from the tariffs and different things, and there seems to be more of that to come as well.
Yeah. Citi in focus, the stock price back to levels not seen since, I guess, record high since 2008 is the number that we're going with. And they also surprised on the trading results, in addition to announcing this share buyback. A vindication of sorts for Jane Fraser?
It's a tricky one. Depends on how far back you look at the price chart. When you compare Citi with JP Morgan, JP Morgan's up about sixfold since 2005. Citi's still down 85%. So if you're a long-term holder of Citi, this is a bit of a welcome relief, but there's a lot of work left to do. Citi lagging its peers in stock price and I guess performance generally.
Yeah, most definitely. You know, one of the stocks that performed negatively yesterday was Wells Fargo, both on the guidance that they gave and also the fact that they missed on net interest income. Are we expecting this trend to play out with some of the other banks, the big commercial banks reporting too?
Yeah, Wells very much is a balance sheet-driven bank. They're hostage to some extent to what the Fed does, and lower interest rates are going to mean pressure on net interest income. Not so much to come from Morgan Stanley and Goldman Sachs, but certainly some of your Asian banks, some of your big balance sheet banks in Europe are going to be hostage to the same series. Notably, a lot of the banks like HSBC have reduced that risk from interest rates, and they're pretty well placed into this down cycle. So shouldn't expect the same kind of pressure to come through for Morgan Stanley and Goldman Sachs, though.
Yeah, well, looking ahead to today, I think there's also going to be a lot of focus on Goldman Sachs and what they have to say on investment banking. Do we expect this surprise strength that showed up in JP Morgan's results to be an anomaly, or could Goldman exhibit a similar pattern in their own investment banking activities?
It's a really good question, and Goldman has said for a while now that there's a lot of uncertainty in the market. They had a very strong pipeline, and we're seeing that come through. Goldman's investment banking volumes are extremely strong this year. I think that confidence is flowing through into deal making. With the sort of more certainty around tariffs, we're seeing a lot more activity. We're seeing volatility back and forth that's going to help Goldman trading. So to answer your question, certainly a strong investment banking performance for Goldman and Morgan Stanley, and that volatility should flow through to their trading income as well. They're not so much exposed to those trends on margin that we saw from Wells Fargo.
Yeah. Interesting that Citi's CEO Jane Fraser was saying that volatility is going to be a feature, not a bug for markets moving forward. So that speaks to, again, the commercial opportunity that they see in trading. Nick, thank you so much. Sorry, Matt, thank you so much for joining us on the show. Bloomberg Intelligence Senior Analyst Matt Ingram. Thank you. All right, a look at how some of the key equity futures are trading as we head into the open. Marginally negative. S&P futures down about 15 basis points as markets digest that CPI data and, of course, the U.S. banks' earnings, as we were just speaking about. European markets also down about 13 basis points, as well as we also keep an eye on fiscal developments within Europe with the French budget proposal coming through last night. Big question as to whether or not it can actually be passed by this government. So that is a focus alongside the tariff and potential countermeasures that could be unveiled by the EU. Now, coming up, markets are dialing back their Fed rate cut bets following weaker than expected U.S. core CPI numbers. Swiss Re shares their outlook next. This is Bloomberg. Good morning. This is Horizon's Middle East and Africa, our top stories this morning. President Trump says Indonesia will buy 50 Boeing jets and more than $19 billion of American products as they reach a 19% tariff deal. Trump also warning pharma tariffs could hit by next month. U.S. 30-year yields top 5% as traders pare back bets on Fed rate cuts, focusing on the potential for higher tariff-driven inflation over the coming months, despite softer core CPI. The world's most powerful finance ministers and central bankers gather in South Africa for a G20 meeting, overshadowed by uncertainty over Trump's trade salvos. It's just gone 8:30 a.m. across the Emirates. I'm Joanna Bersetchi in Dubai. The markets, we are trading slightly in the red, moderately negative after a pullback yesterday for Wall Street. We saw pretty much every sector in the S&P trade in the negative, in the red, apart from the tech sector. A bit of a boost given by Nvidia, other semiconductor stocks on back of that story that we reported yesterday that Nvidia will once again be able to sell some of their AI accelerator chips into China. So that was a big story yesterday. Obviously, CPI focus as well, coming in moderately lower, though some signs that inflation is beginning to creep up into consumer goods. European markets also seen opening down in the red, down 13 basis points. The USD trading sideways as we talk about the potential for the Trump administration to select who Fed's successor is going to be, the Fed Chair Jerome Powell's successor. So in all likelihood, the expectation is that it's going to be someone on the dovish side. So watch out for how this conversation evolves over the next couple of months and how that could impact U.S. financial assets. And then finally, 30-year yield sitting at 5% once again. That is a key psychological level. We've moved up quite a lot in the past couple of weeks and back to levels not seen since the beginning of June. So keeping a close eye on long and term premium. As for the terminal chart today, just to signal as well, in line with what we were saying about Nvidia and regaining the ability to sell some of their AI accelerator chips to China, it's boosted the semiconductor index as a whole. That index has now hit its highest level in a year. Well, U.S. 30-year yields have topped 5% for the first time since June. That's as traders pare back bets for Fed rate cuts despite that softer core inflation. Joining us now is Patrick Sanner, head of macro strategy at Swiss Re. Patrick, really good to have you with us. What is going on with long-end yields around the world? Not just specifically in the U.S., where we've got 30-year yields back at 5%, but we're seeing an upward push in French yields, in UK yields, in German yields, and the big one, of course, JGB yields, as well as we head into the upper house elections this weekend. Why is this happening?
Hi, Joanna. Great to see you, and thanks for having me. So there are a variety of factors. Obviously, fiscal concerns, be it around deficits, somewhat already stretched and fragile fiscal positions with regards to debt to GDP ratios and so on. The geopolitical policy and trade uncertainty that we're seeing, you had alluded to potential inflationary pressures down the road, and ultimately also a co-movement, a global co-movement of assets. And the worsening fiscal outlook is really a key theme across the US, Europe, Japan, China. So that's something that will probably stay with us for a while, and that's also why we are seeing a further normalization in the term premium and some further risk premium being built into the curve.
Is this going to be the new normal for rates around the world? And the fact that, at least in the case of the U.S., fiscal deficits are expected to continue to stay wide, in 5 to 6, 7% range over the coming years. Should investors just get used to the backdrop of long-end rates trading at around 5%?
Well, term premia are definitely back, and I think they're emblematic of a new macro-financial regime where, fiscal and supply-driven aspects as well as policy volatility matter a lot again. But I think it's important to contextualize also where we are coming from. So term premia was basically inexistent for a large part of the 2010s, so post-GFC, and we are now still in a normalization phase. And if you look at the term premium estimates in the US, if you take the average prior to the GFC, then they're still roughly 70 basis points higher than where we are right now. So we are still, I think, in a normalization phase with regards to term premia, and given everything that you had alluded to with the fiscal backdrop, with the policy fragmentation that we're seeing, I think it's reasonable to assume that this term premium is with us to stay.
Yeah. Let me ask you about the German fiscal bazooka. How much of an impetus is that going to be for growth, do you think, in not just in Germany, but as for Eurozone as a whole? Because, again, a lot of focus on increasing productivity, competitiveness, and I just wonder to what extent this package will lead to a significant fiscal multiplier in the region.
It is a notable investment initiative if it comes to fruition. So that's certainly something that is very useful for Germany and the European Union overall. The fiscal multipliers depend a little bit where exactly the money ultimately flows, right? So if there are more investments in, for example, digitalization and really productivity enhancing areas, infrastructure and so on, the multiplier can be quite large. If part of that is more, driven towards military rearmament and that kind of stuff, then the multipliers are typically lower. But the flip side is that Germany has fiscal space to engage in pretty meaningful fiscal easing. Now, whether that happens or not, I think we'll need to see. But I think for global markets, what matters here too is that in Germany, as well as in Japan, they have traditionally been the low yield anchors of global yields, and they are now repricing higher as well. And with it, these global co-movements kind of pull up other yields elsewhere as well. So there are also some spillovers, not only economically, but also what it means for markets.
Yeah, a really valid point there. Let me ask you about the tariff threats to Europe and the fact that the currency has been a very strong performer this year, namely on back of the dollar weakness. Can that continue now that investors and markets are looking ahead and really starting to think about both the growth and deflationary impact these extra tariffs could have?
It could, but I think it's a question of time horizon. So the dollar weakness, or what made it a bit ominous, is that you had a dollar weakness whilst at the same time you had rising yields, which is something that is extremely unusual. Now, with regards to the Eurozone and where we are, I think the ECB has already cut quite a significant amount. I think the hurdle to cut more is actually quite high. I think that does require quite a bit of more softening in particularly labor market readings going forward. That is certainly possible, but I think where we are right now, I think it requires quite a bit more of a slowdown for the ECB to cut a lot more versus what is priced in. And as such, I think Euro-US dollar, has some scope to actually rally a little bit more from where we are right now towards more dollar strength as a result of some of the weakness that we have seen. But again, this is much more a shorter term type of view versus the structural things that are going on in the background, which have presumably triggered a lot of the repricing in the dollar since the 2nd of April.
Yeah, so much to watch out for. Really good to have you on the show. Thank you for bringing your perspectives. Patrick Sanner, Head of Macro Strategy at Swiss Re. Now, the world's most powerful finance ministers and central bank governors are gathering in South Africa for the G20 meeting. Despite concerns over the fallout of a global trade war, South Africa has expressed confidence that the group can agree on a communique for the first time since it assumed leadership of the bloc.
At a moment of ongoing uncertainty in the global economy, uneven growth trajectories, elevated debt levels, persistent inflationary pressures, and the complex implications of tightening financial conditions. The multilateral system is being tested, and our collective ability to respond will shape the pace of our recovery.
That was South African Treasury Director General Duncan Pieterse speaking at the G20 opening address. For more, Jennifer Zabazaj, our Chief Africa Correspondent in Ballito, South Africa, joins us now. Jen, good to see you. It's interesting to hear the comments and the gentleman expressing some optimism, despite the fact, of course, the elephant in the room is that there is not going to be a U.S. representation at the meeting this week. Where is that optimism stemming from in the absence of the world's largest economy?
Right, and Jumana, we should note this is actually the second time that we've seen Scott Bessent actually skipping this meeting since South Africa assumed the presidency of the G20 earlier this year. We also saw Secretary of State Marco Rubio as well absent from the foreign ministers meeting earlier this year. And so, yes, this is surprising that there is a sense of optimism. But what we did hear from the DG is that he says that there are signs of resiliency among some of these members of the G20, and that at least when it comes to the deputies level, that there is a sense of commitment among the policy dialogues and a commitment to wanting to move and push those forward and at least come up with a consensus at the end of the G20 presidency that South Africa is going to hold. Now, the big question really is, what does that look like if the U.S. is not a part of it? And of course, as we continue to see what really looks like to be a fracturing of multilateralism globally, and the U.S. stepping back from its role in multilateralism and the framework of which it stands globally. And what's especially important is that the U.S. is going to be taking over the G20 next year. And so a lot of questions that people are asking is, what does an agreement look like at the end of this G20 presidency? And so this week, a lot of the focus is going to be on some of those issues that South Africa at least wanted to initially go into this G20 focused on, and that is a lot of the issues around debt sustainability. There's also a strengthening multilateral development work, and some of these things that they believe that they can find consensus among all of the parties that make up the G20. The question, though, is will the U.S. come to the party at the end of the year? And ultimately, will we see President Trump at the Leaders Summit later this year?
Yeah, that's the big one towards the end of the year. But as for the rest of this week, Jen, what is on the agenda for these finance ministers?
Right. So this is the fourth convening of the leaders here. We, as Bloomberg News, we're going to be speaking to a number of the leaders. We're going to be speaking to the South African Central Bank Governor, Lesetja Kganyago. We'll also be speaking to a number of finance ministers from Europe who will be attending here. We mentioned, of course, Scott Bessent is not going to be attending, but we will be speaking to the Swedish finance minister, the Canadian finance minister, also the Danish minister for economic affairs. We'll hear from South Africa's Treasury minister. And really the question is, where will we find consensus on a lot of the issues that, again, South Africa came into this with the theme focusing on solidarity, equality, and sustainability? Will they be able to push some of these priorities forward this week and actually come to the table with finance ministers and central bank governors and get some consensus on these issues and move some of these priorities forward in order to get an agreement that these leaders potentially can agree upon later this year? The question is, what will the U.S. agree on? We did earlier this week, though, speak to South African Deputy Central Bank Governor, and he did tell us that he does not see Scott Bessent not attending here as a snub. He sees this is a complicated time for a number of countries globally, and that many countries are facing a lot of competing commitments, of course, one of those being tariffs that they're facing. And so potentially they are able to then come to the table and focus on ways that they can at least align on some of the issues that they do see eye to eye.
Jen, looking forward to your coverage the rest of this week. Jennifer Zabazaja, our chief Africa correspondent in Ballito, South Africa. And coming up, Nigerian inflation is expected to ease, bolstering hopes of a rate cut later this year. We discuss the state of the economy next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Joanna Bersachi in Dubai. Nigerian inflation is expected to show a further moderation when we get June CPI data today. Joining us now is Chiedza Madzima, head of Global Operational Risk Research at BMI, a Fitch Solutions company. Really good to have you with us. Let's just start with the upcoming CPI print expectations, as we are going to see a little bit of a drop from the prior month. Where do you see inflation not just coming in for this print, but more broadly landing for the latter half of this year?
Great. Thank you for having me on. Definitely, we're likely to see the inflation print come down from the 23% level last month for this month, but certainly for the remainder of the year, we expect inflation to hover at around 21.5% on aggregate. And this is, of course, on the back of base effects, of course, relatively contained energy prices, seasonal harvests, and of course, this is all tempering food price pressures. And we can't discount the broad stability that we've seen in the Naira lately, which would have actually limited import price pressures.
Yeah, I mean, obviously the trend lower in inflation is welcome for investors, and it's being reflected in financial asset performance. But at what point do you think the central bank will actually be incentivized to start cutting, i.e., what level of CPI would be consistent with the beginning of the easing cycle?
I think when we certainly get closer to that 21% level, but in terms of the time estimate, we're looking at more end of Q3 going into Q4, where we'll start to see the central bank incentivized to cut. And we're looking at cuts to the tune of around 200 basis points going into 2026.
So I mentioned the impact that this is having on maybe investor sentiment, also stock market performance as well. The Nigerian stock market is at a record high, an all-time record high. What do you make of this recent rally?
I think some of the bullishness that we're seeing in the equities market has certainly been driven by the strong earnings, especially from your leading banks, telecoms, and some consumer-facing sectors as well as industrials. But of course, the second key factor is this reduced element of currency risk. And of course, with increased currency stability, we're seeing increasing, positive sentiment from both local and foreign investors. We can't discount the third main element, which has been the lower returns that we've seen in the bond market. So this is, of course, driving a further rotation into equities. But of course, looking ahead, the outlook does remain cautiously optimistic. Yes, investors are encouraged by the government's reform agenda, by the potential for future growth in key sectors, and of course, the broader economy. But there's still persistent challenges such as global economic uncertainties, of course, still high inflation, still well above the 20% mark, and of course, security risks.
Yeah, you mentioned some of the global macro uncertainties. Why are Nigerian financial assets somewhat immune to the conversations that the world is having around tariffs and the impact that tariffs could have on countries? Why have investors brushed off some of those concerns?
I think on the tariff front, in terms of the direct channels, Nigeria is quite broadly insulated. Only about 10% of its exports from 2024 data actually went to the United States, of which over 90% of those are oil exports. And as we know, the sort of oil segment is exempt from reciprocal tariffs. So while the Trump administration on April 2 announced the 14% tariff rate, the effective tariff rate for Nigeria ends up only being around 0.2% for US bound exports. So it really does stand out as one of the major markets in the region that's most insulated from tariffs. But I do want to highlight that there is an indirect second order channel that we have to consider, given the fact that Nigeria's export basket is quite undiversified, very oil reliant. So a slowdown in global growth, a drop off in sort of global oil demand will then result in sort of downward price pressures on the oil front. And of course, this will weigh on growth, and this will weigh on the fiscal dynamics in Nigeria, especially as the latest budget has an oil price assumption of around $75 a barrel.
Yeah, and it's not just about the price, but also the ability to bring those barrels to the market as well. Chiedza Madzima, we'll have to continue the conversation next time. Really good to talk to you. Head of Global Operational Risk Research at BMI, thank you. And coming up, Nvidia CEO Jensen Huang is in China, where he hailed Chinese AI models as world-class. The details next. This is Bloomberg. Nvidia CEO Jensen Huang arrived in China following news of Washington easing restrictions on chip sales to the country. Speaking at the opening ceremony of the China International Supply Chain Expo, Huang praised China's AI capabilities, calling its models world-class. Bloomberg's Annabelle Jewelers joins me now. As ever, he's the man at the center of the news the last 24 hours. What were some of the takeaways from Huang's speech?
I think it's really just a continuation of that sort of same sentiment that we've seen from Jensen Huang in the past toward China, but just making these sort of overtures and really making the point as well that China is extremely competitive in the AI landscape. So yeah, just some of the things he was talking about this morning at that conference, talking about how AI can give new growth opportunities, how Nvidia as well wants to work with partners on this. And this, of course, has been the big talking point, that the US has reinstated or plans to give back the licenses to Nvidia to once again export its H20 chips to China. Now, this is really important because the H20, which was designed specifically for the mainland market, those chips actually have strong inference capabilities, and that's really the deployment. It allows for the broader deployment of AI tools to reach the masses, and that as well goes back to sort of the state of AI competition in China right now, which is very much at the application layer. Which company can monetize AI best and essentially bring more customers into its orbit. So yes, Jensen Huang speaking this morning after they got that green light yesterday. He also said that they haven't received the export licenses just yet, but we do know that's very much the plan of Washington.
Yeah, well, he must be quite a happy man with the decision that was taken by Washington. With a big upward reaction in the stock price yesterday. Annabelle Jewelers, thank you so much. Always good to get you on the show. European futures markets, US futures are all leaning slightly towards the red. Obviously, still a lot of focus on tariffs and the markets digesting that inflation data from yesterday. That was it for Horizons. I'm Jumana Bersachi in Dubai. Stay with us for Daybreak Europe. I'll be back again in a few minutes. This is Bloomberg.